Hey, folks. Welcome to Market Intraday Analysis by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. Today, Wednesday, December 16th, 2009. Well, folks, as we get started on this intraday video, we await the FOMC policy statement at 2:30 p.m. Eastern Time. And as we get into this video, you can see the markets are slightly higher across the board. The Dow is up 30 points, the Nasdaq is up 15, and the S&P 500 is up about 6.5. That's really about a half a percentage point gain across the board, and we've seen that day after day, and that's something I want to talk about a little bit on this options expiration week. Now, again, options expire on Friday of the third Friday of every month, and what you're seeing here is typical options expiration. And what is typical? Well, typical means whipsaw kind of all week long, and this week we've seen that precisely. If you go back to Monday's activity, you saw a nice little up day on Monday, down day on Tuesday, negating Monday's up move, and then today we find ourselves reversing the down move from Tuesday all the way back up to the highs from Monday. So really it's been up, down, up. And that's kind of what you expect on a kind of options expiration Friday, if you will, or the week leading up into that Friday. Now, again, as we await for the FOMC policy statement today, the market is kind of wondering whether or not the Federal Reserve is going to start to say something about raising interest rates. And we've obviously got a sense that that is what's going to happen. And the reason why you know that's kind of in the works at this point, because the dollar has gained significant steam. If you take a look at the UUP chart, which is the dollar index here, you can see that the lows were put in back here on, let's take a look here, on the 1st of December. Really, you had a nice, beautiful double bottom from the 1st of December going back to the double bottom on the 25th of November on the dollar chart. And from that point, the dollar really started to make a significant climb, and we had called for that bottom and nailed it beautifully as the dollar has traded up very significantly. Now, again, that's telling you that there's something out there that's saying the dollar needs to increase in value, which is usually interest rates. And again, you've seen some of that also in the fact that Dubai had the issues. Whenever Dubai has issues, or any geopolitical country is going to have issues, you're going to see a flight to safety in the dollar, which is going to push it up as well. So today is going to be a very, very key meeting in regards to what to expect out of the Fed in regards to interest rates. And we'll continue to watch that into the meeting today. We're covering it live in the intraday stock chat as well as we get, back into the afternoon session here after lunchtime. Now, going back to the spiders, let's go back to the SPY, which again mirrors the intraday S&P 500. Again, you're seeing that somewhat upside move today, but the markets are not that volatile. Again, you gapped up, you went down a little bit, you went up, and you went down a little bit. You're holding in a relatively tight range between this 112.15 level and really the low down here at 111.75. So you're really talking about a 40-cent range on the spiders up and down today, which in general for what you were used to, that's a very, very tight move on the spiders. Now, again, a couple things and tidbits to go over. The dollar is slightly weaker today, and I'm going to express why. I want to make sure you guys fully understand why the dollar is weaker. Number one, yesterday we had a nice gap up in the dollar and a push up in the dollar. Why? Because producer price index indicator, the PPI, was released yesterday, and that showed that inflation was creeping up on the producer side of the kind of the curve, if you will. When the goods are produced, producers obviously purchase the raw materials and then produce something, and then it's gone to the consumer. So the producer side of things, buying raw materials, buying this, buying that, their costs are going up, and actually much, much more than expected. When you see costs going up, that obviously indicates inflation. How do you combat inflation? You combat inflation by raising interest rates. Therefore, raising interest rates, the dollar goes up. That's what we saw yesterday. Now, today we got consumer price index, which again is on the curve of the consumer side, which is after the producer makes the good and sells it whole to the consumer. And consumer prices were very, very slightly. And if you take out food and energy, they were basically flat. Now, what does that mean? Well, that came in less than expectations and essentially showed us as well that while producer prices are rising, you are not able, or the producer's not able to push those cost, those rising costs through to the consumer yet. Now, that's the beginning stages of inflationary timeframes. Usually, costs go up to producers, and then eventually they pass them on to consumers. And when they pass them on to consumers, that's really when the inflation, kind of red bells and flashing lights go off, and you have to really be worried. Right now, it's just a producer issue, and that's not an issue right now for the overall economy. So coming in less than expected on the consumer side, that's going to weaken the dollar. Why? Well, if there's less inflation on the consumer side, interest rates don't need to go up as fast, and ultimately that means the dollar will fall. So you guys see the kind of the pattern going. Yesterday we had whipsaw because the dollar rallied on the producer. Today the dollar fell on the consumer CPI, and that is where we stand today. And obviously if the dollar's down slightly today, the markets therefore should be up. Now, generally going into a Federal Reserve meeting, the markets are higher as well. So keep that in mind, guys. That is just a normal thing. We've seen that, time and time again. And part of it is that the position of the Fed is very, very clear. They want to maintain a relatively weak dollar policy. Weak dollar policy means that you will see the markets generally trade up if the dollar continues to get weaker until you have that inflection point, obviously, where it just starts to collapse. Then it's a bad thing for the economy. But in any case, just note that as well. This is the same as last Fed meeting, the same as the Fed meeting before. Markets were slightly higher or nicely higher going into that meeting. And again, we will see how things play out in the coming hour here as we get that number out at 2:15 p.m. Eastern Time. Now, we had a couple other key signals today. We got some housing indicators out there, and for the most part, the housing numbers came in decently. We had a real drop in housing permits and initial, housing starts last month. This month, they rebounded. Last month, they were down 10% or so. I remember the market sold off pretty sharply on those numbers, and then ultimately this month, we did see a push back up in those economic numbers, so it kind of moderating a little bit from that ugly number as well. But for the most part today, folks, all eyes on the Fed. The reason why it's on the Fed is because you have to look to see in the statement, are they going to change to a more hawkish stance on inflation, therefore more likely to raise interest rates? I personally don't think so. I think overall the Fed is not going to really do too much in the near term anyways. Longer term, I do expect it, but I don't expect an increase in interest rates until probably mid-2010 at least, if not late 2010. I just think they're going to wait on the sidelines. They're too scared, and there's too much, kind of political pressure from the Obama administration and Geithner to keep interest rates low so this economy gets back on. Remember, it's all political, and remember, the Fed is actually supposed to be independent. The Fed is an independent bank. However, to think that they're actually independent is just nonsense at this point. I mean, that's just the biggest farce in the world, as it's obvious they're not independent. I mean, there's way too much political pressure being put on them. You have the president, threatening not to appoint Bernanke again and so forth. I mean, that type of, obviously he did reappoint Bernanke. He has to be confirmed still. But my point is, if Bernanke wants to keep his job, he better do what the, president says, in other words, if you know what I'm saying. So in any case, folks, that's where we sit here. The market has very light volume. That is normal ahead of a Fed meeting. It should pick up dramatically. And again, watch the dollar chart on the Federal Reserve announcement to see where it goes and keep an eye on that as well. Are we going to get a big spike up? Are we going to make new highs in this market, 52-week highs? Or are we going to collapse back down and start heading back to some key levels? As always, folks, if you want more technical information, and we give hardcore technicals in the nightly videos to our premium subscribers in the Research Center, along with everything else included under that Research Center for that one low price of $49.99, you can go join at any point, get those videos. That's in priceless. You want to be on the cutting edge of this market going into the end of the year, so you're set up for the new year, and that is key, guys. A lot of craziness going on now, and you have to be aware of what's going on with the dollar, with gold, with oil, and get the right calls, the right guidance, and the right education from InTheMoneyStocks.com in the Research Center or the chat room. All right, folks, have a wonderful rest of the day. We will talk to you tonight for those of you that are premium subscribers, and otherwise we'll talk to you all tomorrow. Take care.